Hey guys, wages rose 5.1% on a year-over-year basis. That means people are being paid 5.1% more than they were being paid last year at this time. The Federal Reserve hates this. The Federal Reserve is furious about this because this hurts their ability to fight inflation. And I'm going to tell you why on this video. So let's jump right into it, guys. There's a reason why the Fed doesn't want wages to go up too fast, too soon. Now, you're probably asking yourself, how does wages affect inflation? Well, it's because the cost of producing goods and services goes up as employers have to pay their workers more and more, right? So to make up for the increase in the cost of labor and the increase in the cost of wages, companies then have to turn around and charge more for their goods or services. They have to ultimately increase the price to support the higher wages that they're paying employees, because every company wants to stay in business and remain profitable. Well, if they have to pay workers more money, then they have to raise prices in order to offset that increased cost of labor. As we all know, the biggest expense of any business is typically labor, right? And labor is paid through wages. And also, guys, when wages increase too fast, too soon, it means that more and more people have more money to spend. And when more people have more money to spend, guess what? They'll spend it. And that keeps the demand for goods and services high, in turn keeping prices high, making prices go up faster. And that, of course, is higher inflation. So there's sort of a twofold thing going on there, right? Not only does a business have to charge more money to keep up with paying higher wages, but also when people make more money, they're going to spend more money. So there's a couple of things there that is really pushing prices up and pushing inflation higher when people make more money and they have higher wages too fast. Higher wages that are not consistent with only a 2% inflation rate. So guys, understanding labor is really key to understanding not only business, but also to understanding what's going on with our inflation and the connection between wages and prices going up too fast. And so the Federal Reserve, they want to see the cost of labor go up, but go up at a much slower rate than we've seen recently, because that's going to help fight inflation. It's going to take a little bit of money out of people's pockets right now so people don't have too much money to keep spending. And also, when the wage rates rise slower, it's going to keep businesses from having to increase the prices of their goods and services because they're not increasing the cost of their labor at such a fast rate. So wage growth is good for the average everyday person that's working, but it's not necessarily the best news for actually trying to fight inflation. And because of what's happening with the increase in wage rates right now, it gives us the indication that for the foreseeable future, interest rates are going to keep going up. Now, the facts are this, guys. Wages for workers in America rose 5.1%, and that is 5.1% more than they were up last year at this time. Now, the Federal Reserve hates this. The Federal Reserve is furious that wages are up so much. Now, this 5.1% increase in wages helps employees keep up with the rising cost of goods and services, right? And the general rising cost of living. But it sort of complicates what the Federal Reserve is trying to do with inflation. The Federal Reserve is trying to lower inflation. And when your wages are up 5.1%, that means prices are going to be up. And it also means that more and more people have more money to spend. For private sector U.S. workers being up 5.1% in March and up 1.2% from December, it sort of goes against what the Department of Labor and all the experts were thinking, right? Sounds good and it feels good that we're making more money and wages are going up and everybody has more money to spend, but that's the problem, guys. People have more money to spend. I mean, think about it like this, guys. A company has to pay people. And the more they have to pay people, the more they have to figure out where the money is going to come from. And when they figure out where the money is going to come from, guess where it comes from? It comes from an increase in the price of whatever good or service that company is selling. And that helps them pay for the labor. And those increases, it's going to take longer to bring inflation down to that 2% level that the Federal Reserve wants, because businesses have to pay these increased wages. So inflation stays high for longer. Now, we know the Federal Reserve has been raising rates for the last year in their effort to cool down the economy. and ultimately bring down inflation too. Now, wages are a huge piece to that puzzle, guys. And the labor market right now is showing record low unemployment, right? And there's more jobs out there to be filled than there are workers to actually work the job. So the Fed doesn't like it. The Fed is trying to strike a delicate balance here, right? With raising interest rates, they're trying to raise the cost to borrow money enough to discourage hiring and also to ease some of these pressures on wages, so wages don't go up too fast too soon. But at the same time, they don't want to raise the cost of money or raise interest rates so much that companies have to start laying off workers at a huge level, which could ultimately lead to a recession or a major slowdown in the economy itself. Now, that's sort of the balance. Now, at the same time, we do know that inflation has come down. It's coming down slowly but surely. It was at 9.1% last June or July, and now it's down to about 5 to 6%, depending on if you're using the CPI inflation readings or the core PCE inflation readings. But it's coming down slowly. But the Fed wants it to come down quicker. And the best way to do that is to make sure that wages aren't rising too fast, too soon. Now, thankfully, we know that some of the larger companies out there have begun, especially on the tech side, have begun to sort of lay off a few workers here and there. Now, I say thankfully because I'm looking at it from the side of wanting to see inflation going down so the everyday average American can start to afford things more so. So the technology sector has sort of cooled off. We know that housing, because of the higher interest rates, have sort of cooled off as well. And those are good things, right? But with all that said, guys, this latest report that just came out a few days ago regarding the increase in wages is pretty much a downer for the Federal Reserve and what they want to see. Because right now, guys, wage rates are actually rising faster at 5.1% year over year. They're rising faster than before the pandemic. So the real worry here is that if companies have to keep raising the price of their goods and services to make up for the increase in wage rates, it's going to make it difficult for inflation to come down soon enough and get to that targeted 2% rate that the Federal Reserve is saying they want. Now, here's what you got to know, guys. You can be happy and thrilled that people are making more money to actually be able to afford the higher price of goods and services. But just remember, what looks good on the surface is not always good for the overall economy and prices coming down as we want. Keep in mind that wage rates, unemployment rate, and new jobs that are created, all those things are key indicators that we've got to watch closely, because those are the things that the Federal Reserve is basing their decision on, whether or not to raise rates or lower rates or keep rates the same. So I hope I was able to explain to you guys exactly why the Federal Reserve does not want to see wage rates go up too fast, too soon. Hey, if you got anything at all out of this video, guys, do me a small favor, smash the like button. That helps this video get out to more and more people. Also, subscribe if you're not a subscriber, and drop me a comment below. I want to know what you guys think about the 5.1% increase in wages over the last year. Good? Bad? What is your take on it? Let me know in the comments below, guys. Hey guys, do me a favor and check out a few of these videos that I put right here above me for more discussion on jobs, unemployment, and wage rates and how they affect inflation. Hey, the best person to take care of the old you is the young you. Do me a favor, take care of yourself. And guys, always take care of other people. Until the next video, peace!